Welcome back to TakePropips. Today, we're diving into an exciting and crucial topic for Forex traders. The top 3 ways to use GDP data in Forex trading. Understanding how GDP, or gross domestic product, influences currency markets can give you an edge, helping you make more informed trading decisions. Whether you're new to Forex or an experienced trader, this video is going to break down how you can leverage GDP data to improve your trading strategy. First, let's start with the basics. What exactly is GDP? GDP is a measure of the economic performance of a country, representing the total value of all goods and services produced over a specific time period. It's a key indicator of a country's economic health. When GDP figures are released, they can have a significant impact on currency values, which is why it's so important for Forex traders to pay attention to these numbers. So, how can you use GDP data in your Forex trading? Let's jump into the first way. 1. Trading on GDP announcements. One of the most straightforward ways to use GDP data is by trading around the time of its release. GDP announcements can lead to significant volatility in the Forex market. For example, if a country's GDP growth exceeds expectations, its currency is likely to strengthen as investors gain confidence in the economy. Conversely, if the GDP falls short of expectations, the currency might weaken. Let's say the United States is about to release its quarterly GDP figures. If you anticipate a strong GDP report based on other economic indicators like employment data or retail sales, you might position yourself to buy the USD against other currencies. On the other hand, if the indicators suggest a weaker GDP, you might prepare to sell the USD. However, trading on GDP announcements isn't just about predicting the number. It's also about understanding market sentiment and the possible reactions of other traders. Sometimes, even if the GDP data is good, the currency might not strengthen as expected if traders had already priced in the good news beforehand. This is where having a tool like the Trading Management Solutions EA from TakePropips can be incredibly helpful. With features like real-time analysis and automated trading, you can quickly adjust your positions in response to the latest data, minimizing your risk and maximizing your potential for profit. 2. Understanding the long-term impacts of GDP trends while trading on immediate GDP announcements is one approach. It's also important to understand the long-term trends in GDP data. Consistent GDP growth over time is a sign of a strong economy, which typically leads to a stronger currency. On the flip side, if a country's GDP is stagnating or declining over several quarters, this might indicate economic troubles ahead, potentially weakening the currency. For long-term traders or those using a swing trading strategy, analyzing GDP trends can help identify the underlying strength or weakness of a currency. For instance, if you notice that the Eurozone's GDP has been steadily improving while the UK's GDP has been declining, you might consider taking a long position on Euro GBP. To aid in this analysis, the Trading Management Solutions EA provides tools like the Trend Scanner and Currency Strength Meter, which can help you monitor the broader economic trends and the relative strength of currencies. By combining these insights with your GDP analysis, you can build a robust trading strategy that's aligned with long-term economic realities. 3. Using GDP as a confirmation tool for other indicators. Finally, GDP data can be used as a powerful confirmation tool in your trading strategy. Forex trading often involves analyzing various economic indicators such as inflation rates, employment figures, and interest rates. GDP data can serve as a way to confirm or challenge the signals you're getting from these other indicators. For example, if inflation in a country is rising but GDP growth remains strong, it might suggest that the economy is robust enough to handle higher prices, which could lead to an interest rate hike by the central bank. This, in turn, could strengthen the currency. Conversely, if inflation is rising but GDP growth is sluggish, the central bank might be hesitant to raise rates, which could weaken the currency. In this context, GDP data adds an extra layer of confidence to your trading decisions. Let's say you're looking to enter a trade based on strong employment numbers in Canada. If the Canadian GDP data also shows strong growth, this could confirm your decision to go long on the CAD. On the other hand, if the GDP data is weak, you might reconsider or at least approach the trade with more caution. With the TakePropips Trading Management Solutions EA, you can automate parts of this analysis, setting up the system to trigger alerts or even execute trades when GDP data aligns with other key indicators. This level of automation not only saves you time but also helps you respond quickly to market changes, ensuring that you don't miss out on profitable opportunities. In conclusion, GDP data is a critical tool in the Forex trader's arsenal. Whether you're trading on the news, analyzing long-term trends, or using GDP as a confirmation tool, incorporating this economic indicator into your strategy can significantly enhance your trading performance. And remember, having the right tools, like the Trading Management Solutions EA from TakePropips, can make all the difference in executing your strategy effectively and efficiently. If you found this video helpful, make sure to give it a thumbs up, subscribe to the channel for more trading tips, and hit the notification bell so you never miss an update. Thanks for watching, and as always, happy trading!